Woo! You graduated. But wait a second. Did you take a moment to think about all that debt you were accruing? Student loan debt is the second largest consumer debt category behind mortgages. And the tragic part is many of us don't even use this to our advantage because over 32% of undergraduates don't get a degree. Like me. And no, this is not isolated to the few. 43.4 million Americans are carrying this debt burden together. This is an issue that we need to fix immediately. But what are student loans? What should you do if you have them? What should you do if you're considering getting them? Let's get back to basics. 26.7 million. That is the number of Americans who saw their student loan payments restart last October for the first time in 3 years. These restarts represent 61% of all student loan borrowers in the United States, and as of 2023, there are a total of 43.4 million borrowers with a collective $1.63 trillion in debt. This makes student loans the second highest consumer debt category behind mortgages. Of these borrowers, the average balance is $37,718 for federal loans. Over the past 60 years, the cost of college has tripled, growing 8 times faster than wages. But student loan debt on its own is not the only problem. Nearly a third of people with student loan debt take on new credit card balances, and 15% took out a personal loan. On top of that, the average car payment has ballooned to $729 a month. Americans are now saddled with much more debt than before the pandemic, making that extra loan payment much harder than it was before. All of this is happening in the midst of rising inflation, rising interest rates, tech layoffs, and a shaky economy. These factors combined mean that Americans are paying much more for the same things they bought last year, while at the same time dealing with reduced incomes and uncertainty around their future. To add insult to injury, most Americans cannot bankrupt their student loans. This is all very scary, but death by student loans doesn't have to be our fate. In fact, for most of us, our student loan payments are likely well within our means. If we have the right tools and take the right actions, we can get these paid off and properly managed in reasonable time. If you haven't taken on student loans yet, then congratulations, you're in great shape. But there are many things you can do to avoid the fate of those 60 million Americans. By the end of this video, I hope you'll know the pitfalls to avoid and the steps you can take to control your loans. But first, how did we get here? While different forms of student loans existed well before this, student loans as we know them started in 1958. The space race was well underway, and America was in competition with the Soviet Union to explore the vast unknown. In 1957, Americans were spooked as Russia launched the first space satellite, Sputnik. At this point, America was shaking in our boots. Were we falling behind our rivals? Was the United States' reign as a world leader ending? We couldn't just let that happen, obviously. As a result, President Eisenhower took swift action and signed the National Defense Education Act that helped fund math, science, education, and engineering degrees as well as foreign languages. With these loans, talented and promising high school students could go on to restore the dominance and glory of the United States, keeping us at the top of the food chain for many decades to come. From there, we were off to the races as more federal and private student loan programs were introduced. We were no longer just funding those math and science programs, but everything under the sun until over 50% of college attendees were borrowing to fund all or part of their education. Over the next 60 years, the average student loan balance would balloon to over $37,000. Starting in 1965, student loans were made more broadly available with the introduction of FLELP loans. With this loan, students could receive federal grants and loans from private banks. These loans were guaranteed and subsidized by the federal government, which means that if you failed to pay, Uncle Sam was on top of it. In 1972, the Basic Education Grant was introduced. This is what we now call the Pell Grant. This bill was introduced to help low-income students afford their education and lower their interest burden. Then in 1992, higher education amendments provided unsubsidized loans to all students enrolled in qualifying colleges, universities, and other institutions. In 2010, FFELP was eliminated and the industry began to evolve into the modern private and public loan industry that we see today. So with college costs more than tripling over that time and far outpacing our increase in wages, are you prepared to pay these off? Well, let's get into the types of loans and see what you need to do. Now, there are two types of loans. This is, of course, federal loans and private loans. Simply speaking, federal loans are backed by the United States government and private loans are not. Federal loans account for about 93% of the student loan market, while the private loans account for the other 7%. And there's good reasons for this. Federal loans provide many protections that private loans do not. First, the terms are set by the federal government and by law, so you always know what you're getting into. Federal loans also tend to have much lower interest rates and more consistent terms. Some are even subsidized, which means you aren't accruing or paying interest on those loans while you're in school. That can save you a ton of money over time. Now say you graduate and you need to start paying on these loans, but you do not have the income to meet the minimums. Congratulations! You're in luck, as there's different income-driven repayment plans and payment options that make your student loan burden easier. All of this so you can get back on your feet. So if you only have these public loans, clap, clap, clap to you, as you've given yourself a bit of grace and avoided one of the largest pitfalls, which is the private student loan industry. As mentioned, with public student loans, there are many payment options, but the best one to save your money is clearly the standard repayment plan. Now look at your situation and determine what's right for you. But for most of us, the standard repayment plan is best. With this plan, you'll have your student loans paid off in just 10 years, and you'll do so at the lowest interest rates. This means you'll not only pay the least amount over time, but you'll be free from student loans quicker. Before you start paying on these loans though, make sure you check and see if you qualify for any student loan forgiveness under the PSFL program, teacher loan forgiveness, or the income-driven repayment plan. PSFL, or the Public Student Forgiveness Loan Program, is built for public service workers employed by the government or a nonprofit. The Teacher's Forgiveness is built for teachers, as the name suggests. You may qualify for this program if you work in a low-income area or for an educational service agency. Qualifying for these programs can be difficult, but I've included links below this video so that you can look into each program. There are a ton of unclaimed funds out there, so if this sounds like you, be sure to apply. When it comes to federal loans, you can also pay off these loans faster, but there are pros and cons to doing so. Paying off your student loans fast can take a major burden off your back and frees up a lot of money, but because of compound interest, the earlier you can start investing, the more money you'll have later in life. So feel free to consider paying off your student loans earlier so you can take that money, invest, and secure your financial future. If your loans are under 5%, you may want to pay the minimums under the standard repayment plan and invest the rest instead. This is because the S&P 500, which represents the 500 largest stocks in the United States, returns an average of 8 to 12% a year. This means that it could be more beneficial to invest any extra money into the stock market instead of putting that towards paying down your loans. Now, if you're just taking that money and just buying Starbucks, then you aren't getting any of the benefits. So in that case, just pay off the loans. Recently, President Joe Biden introduced a new student loan repayment plan called the SAVE Plan. This income-driven plan would lower your payments to 5% of your income, and you would not incur extra interest by taking this option. For some borrowers, you could even see your student loans forgiven in as little as 10 years. This means that anything you don't pay will be forgiven. This might not be the best plan for the average borrower though, as it'll take you 25 years to reach forgiveness, meaning you'll just be paying your student loans for a longer period of time. And without getting into any politics, because we like to stick to objective facts here, we do know historically that a lot of forgiveness plans are based on the administration at the time. So sometimes it can be less risky to just pay this off in the standard 10-year period and live the rest of your life debt-free. But if you have $12,000 or less in student loan debt that won't be paid off in 10 years, under this plan, it could be a great option for you. And of course, the fun part. Let's talk a little bit about private student loans. Private student loans don't always offer many of the same protections that federal student loans do. These loans generally have varying interest rates, with some being as little as 3% and others being as high as 14%. Private student loans can also have variable interest rates. This means that you could be paying much higher interest rates in the future, as the interest rate when you signed up is not necessarily locked. Some variable rates can start as low as 1%. They look enticing, but be aware, as you're taking on a big risk by allowing these to increase in the future. Private lenders can also require you to make payments while you're still in school, or establish credit and get a co-signer in order to get approved. This could mean taking on more debt or putting friends and family on the hook for your high interest loans. That kind of starts making family reunions a bit awkward. So with private student loans, make sure you look at the terms of your loan. Are you paying high interest? Do you have a variable rate? If so, it might be worth considering refinancing with other lenders, which can take on your loans for lower interest rates. At the time of filming this video, we see fixed rate loans between 5.85% and 9.34%, and that's getting locked into a 10-year repayment program. So that means this option could save you a considerable amount of money over the years if you're on the higher end of the interest scale. Once you get on the best repayment plan for your situation, sit down and take a look at your income. Are you making as much as you can be right now to be paying on your loans? If not, do the obvious and ask for a raise at your job and see what comes of that. But we all know that studies show switching jobs has a far greater increase on your salary than moving up with the same company. At the same time, all of this is easier said than done, and we know how the current job market looks today. If you've been at your current company for a couple years and are ready for a switch, consider taking that leap. With the risk comes the reward. We advise asking for 10% more than your current salary when looking for a new job outside of your company. Certification programs and trade schools can also be tools to increase your income and put those extra savings towards student loans. Alternatives to college are everywhere now. There are UX, UI, and product management programs that can get you into a high-paying tech career. Even though the current tech market has been a little rough this year, look towards the long term. There are also more traditional trade schools which have been gaining popularity over the years. And speaking of traditional trade schools, mechanic and repair trade programs saw an enrollment increase of 11.5% from spring 2021 to 2022. So now we've gone over what you can do if you're already in debt, but what if you haven't gone to school yet or are in the middle of college? Well, in that case, there are plenty of ways to get the education you need without being subject to the fate of most Americans. First, obviously college can be a fun and enticing experience, but remember that it is a costly commitment, even though you haven't actually paid for it yet. If you're in college, figure out what you want to do after school quickly and determine if your loans are worth that to you. Many experts recommend that the totality of the loans you take on should not be more than your expected first year's salary. So if you're expecting to make $60,000 in your first year, don't take out more than $60,000 in loans. Look up the average salary of your expected job online to figure out where you may land. As a first-year employee, you'll most likely land lower in the expected range, so don't assume the average or median immediately. Take advantage of lower cost options like community college. Where you go to school has a minimal effect on your earnings, so take advantage of those cost savings in the first 2 years. You'll have plenty of time to get the full college experience in your junior and senior years, so save the money now. If your loans are unsubsidized, that means they'll accrue interest as soon as you take them out. Due to compounding, this can dramatically increase your student loan amount. Try and pay some of this off while you're in school if you work or have some savings. Or you could even use that amount to invest if your student loan percentage is under 5%. Cap your federal student loans first and think carefully before you take on private student loans. If you are in a position where you are forced to take on private loans, this could be a sign that you're spending too much on your education. If this is you, reconsider your school or program of choice. Unfortunately, we don't live in the perfect dream world where we can do anything and everything we want without consequence. So even though that seems a bit dreadful, remember, you aren't stuck relying on just student loans to pay for your education. There are many grants and scholarships offered to students by a variety of organizations. You likely qualify for a good amount of these. Take the time to look up scholarship opportunities and apply for as many as you can like it's a full-time job. You'll be grateful you did this once Uncle Sam comes a-knockin'. And if you have kids, no bad debt, and a fully funded emergency fund, start saving for their education now. Education savings accounts and 529 plans have many tax benefits and can allow your kids to go to school worry-free. Talk to a trusted financial advisor or do some research on your own to learn more about these plans. We can also go into them in future videos if you think that would be helpful. Let us know in the comments below. So getting a strong foot to securing your financial future starts today. If you want more videos like this, make sure to like this video and subscribe below. Also, let us know what kind of topics you want to hear about and we'll make those videos in the future. And don't forget to check out the resources that I personally use in the description below or would use in specific situations.